Hi, and welcome to the 2020 Economic Recession and Preparation channel. I'm your host, Tony. Thank you for joining me once again. Today, I want to talk briefly about the U.S.-China trade deal. As well, I want to touch on the current bond yield stagnation that some economists suggest mirroring the late 1800s long depression that they had. Now, if we look at the bond yield market, we know that the yield curve has been inverted. The 2-year and the 10-year yield curve has been inverted for quite some time now. An inverted yield curve marks a point on a chart where short-term investments in U.S. Treasury bonds pay more than the long-term ones, and is, of course, widely regarded as a bad sign for the economy. So here we have some economists, according to CNBC.com, is comparing the 1800s long depression to the current bond yield stagnation. So here we are. We see these markets. We see that we've just closed in on record highs, quote unquote, last month, November, with the Dow cresting over 27,800 points. But despite that, we have an inverted yield curve, which provokes mixed signals here. So what is really going on? Well, for starters, it's never a good sign when investors are selling off, it's never a good sign when multi-billionaires like Warren Buffett and others are hoarding cash in their companies and they're not purchasing big ticket items. What do they know that we do not know currently? It seems like the sales are coming. It seems like the discounts are going to be coming soon. But it's a long game. It's a game of patience, okay? The long depression in the 1800s, they began with a financial panic, which facilitated 2 decades of dire productivity, deflationary price dynamics, stagnant middle-class incomes, and a surge in populism, coupled with a backlash against globalization. Well, it looks like we're here again, my friends, because this is exactly where we're at today. We have a U.S. manufacturing PMI index down for the 4th straight month heading into December, this new month. Now we go into December 1st. We're going to see how those numbers are. We will experience a deflationary recession later on. Not now. It will happen later on in the 4th quarter of 2020 into 2021. And that's when things are really going to get bad. And we're going to be looking at possibly even a depression, okay, later on in the picture. Things are just setting up now. But we do have stagnant middle-class incomes. Wage growth has not been seen since 40 years. Since 1978 was the last time that we actually had a wage growth that actually outpaced inflation, okay? And you can verify that through the statistics on Market Watch and the statistics that the Federal Reserve put out. So we also have a backlash against globalization. The Hong Kong protests may be the black swan event that's going to set this thing off, because the U.S. has just sided with Hong Kong in democracy protests today. I was reading an article, and the Chinese Hong Kong students marched to the U.S. consulate embassy in Hong Kong to thank them for their support. And so that's one black swan event that is going to be continuing to accelerate as we head into 2020. There's been a lot of violence in South America as a result of bad economies. As a matter of fact, the economy of Chile, the economy of Argentina, the economy of Brazil even slowed down last month. And so as the world economies get bad, it's going to be like dominoes, and it's going to affect the U.S. economy, because the U.S. currently doesn't produce anything. It is a consumer. 2/3 of the U.S. economy is consumption, and the U.S. imports 2/3 of its products currently, either through China, Thailand, South America, Mexico. All of your food, most of your clothes, as you know, comes from these places outside of the United States. And so this is going to accelerate the long-term recession depression event that we're facing. And these economists, these experts that are telling us this on these various media platforms, some of them are right, some of them are right. But as with everything with the media, there's half-truths mixed in with lies, okay? And that's everything. So we have to take this with a grain of salt. But this goes to show you that there can be a long-term event. We've had long-term depressions and long-term event. And the inverted yield curve, the market does provide one of the accurate measures of the true growth of an economy. So I just want to throw that out to you there to let you know. Now, the U.S. China trade deal, I'm not going to talk briefly. I'm just going to talk briefly about this. As you know, December 15th is the deadline that President Trump gave to them, the Chinese authorities, about whether or not they should accept the Phase 1 deal, which included a tariff hike of 15% on all Chinese goods imported into the United States. So the Chinese will come back and say, look, we're not going to deal at this poker table too much longer. We want you to make some concessions. We want you to drop that tariff hike on December 15th, and then maybe we'll be able to talk about implementing a Phase 1 deal. And I remember the Chinese also said previously in November 2019, last month, that they don't want to put a number value on the amount of agricultural goods. As you remember, President Trump and then President Xi, they met and they were saying they were going to buy $50 billion or $60 billion of agricultural farming goods in the Midwest. Well, now they came back to the poker table and they said, look, we don't want to put a number deal on that. We don't want to limit ourselves to how much we want to buy or how much we don't want to buy in this Phase 1 deal. The bottom line is there will not be a Phase 1 deal throughout the remainder of 2019 and possibly early first quarter 2020. There's not going to be a Phase 1 deal. Nothing has been written in stone. If it ain't written in a contract, if a contract is not written down, then you know the rest. It didn't happen. Okay. And the media will come out and eventually say that later on next year as we head toward first quarter 2020 next year, that the China trade deal Phase 1 is going to take longer. They're going to go sit at the poker table some more, maybe in another country, maybe in Germany this time, maybe they'll meet in South Korea this time or some other place. But that's the bottom line, okay? Now, Chile has made a push saying that they need the China trade deal because Chile is highly dependent on commodity prices. Nearly 50% of Chile's trade is done with Chinese. So they need a trade deal between U.S. and China, according to Rodrigo Yanez, the Chilean Vice Minister of Trade. So there's others coming out here, and they need a trade deal because the U.S. and China account for 50% of Chile's trade in South America. So they're looking for a deal. They're pushing for a deal. But unfortunately, Chile is surrounded by a bunch of economically unstable countries at the moment. Argentina's economy is on shaky ground. Brazil's economy is starting to stagnate. And other countries in the region, Bolivia's economy, they just had a riot in Bolivia due to the economy. Is under collapse, under siege. The peso, the Bolivian peso was under siege. The Argentine real was under siege. And so Chile is not in a position to make any kind of persuasive argument to the U.S. or China to get to an agreement. Okay, but they, according to CNBC.com, said that they had pushed their Prime Minister of Finance is pushing the U.S. and China for an agreement. Well, they just don't have that kind of presence to grow to offer any type of persuasive push. So I don't see that happening anytime soon. So, guys, our recourse today is that we need to prepare not only financially but socially for what's going to happen, because as the GDP growth slows in the United States and consumerism slows, people realize that pull back and they realize they need to save money and they need to get more supplies and resources, real tangible assets like gold, silver, food, water, ammo, medicine, okay? And as more and more people come into the country that, quite frankly, shouldn't be here, that's what we're going to experience. Shortages in food. We're going to experience shortages in water. We're going to experience shortages in money, cash, actual hard cash. Now, I told you before, the ultimate goal of this master plan is to move us off hard cash and into a digital currency where they can control whatever we have in our banks, whatever we have, a bailout, a bail-in, they can control what we have on our credit cards or digital cards or whatever. That's the ultimate goal, is to move to a cashless society, okay? But if you have hard, tangible cash, you will be one of the few that will be able to make it through the initial stages of this transition reset, okay? Gold, silver is good too, ammo, food, water, medicine, and also, of course, our faith is going to help make it through in God, okay? So, once again, there will be no China trade deal in fourth quarter 2019. There will be no China trade deal in first quarter 2020. a phase one deal. That's what I'm talking about. It will not be. And also, we need to watch out for the canary in the coal mine, okay? The Black Swan event taking place possibly between summer 2020 and the election time, fall 2020 for the U.S. That could set off the economy and put it in a real bad position for the election time for whoever gets the next presidency for the United States between 2020 and 2025, okay? So those are two canary in the coal mines to look out for. Thank you for joining me today. I hope to hear from you. Place anything in the comments that you have, any questions that you have, and I'll be sure to try to address them in the next video. Until then, stay safe. God bless. God bless this country, and I'll talk to you very soon.